Welcome to 10 Reasons Why You Are Still Unprofitable, presented by Morrofx. Trading is one of the most tempting pursuits in the world. The idea of turning knowledge into freedom, of controlling your financial destiny, draws millions of people to the markets. Yet the harsh reality is that the majority of traders never become consistently profitable. They may experience short bursts of success, lucky streaks, or even months of gains, but eventually the market takes it all back. The cycle repeats, and frustration grows. Why does this happen? It's not because the markets are unbeatable. It's not because profitable trading is impossible. The truth is far simpler: most traders are defeated not by the market, but by their own psychology. The inner battle is where the war is lost. This audiobook will expose the 10 most common psychological reasons why you are still unprofitable, and more importantly, it will give you the solutions, the mental adjustments, habits, and disciplines you need to finally break the cycle and move toward consistency. Let's begin with the first reason. The number one reason most traders fail is that they have no clear plan. Without a trading plan, every decision becomes a gamble. You may know how to identify a candlestick pattern or a support zone, but without rules for when to enter, when to exit, how much to risk, and under what conditions to act, you're simply guessing. Guessing may give you occasional wins, but it cannot give you consistency. Psychologically, traders without a plan are at the mercy of their emotions. Fear tells them to exit too early. Greed pushes them to hold too long. Impulse leads them into setups that never matched their criteria in the first place. A plan protects you from this chaos. It becomes your anchor in stormy waters. Warren Buffett once said, "An idiot with a plan can beat a genius without a plan." In trading, this is absolutely true. Even a simple plan, executed consistently, will outperform random, emotional trading. The solution is clear: you must write your plan. Define your entry conditions. Define your risk per trade. Define your exit rules. Make it so clear that anyone reading it could execute exactly as you would. And most importantly, follow it. Without a plan, profitability is impossible. The second reason you remain unprofitable is overtrading. Overtrading is the silent killer of accounts. It happens when you take too many trades, often out of boredom, greed, or the illusion of opportunity. You may have a system, but if you apply it too often, you dilute its edge. It's like a poker player who can't fold. They burn through chips, not because they lack skill, but because they lack patience. Overtrading is rooted in impatience. The human mind struggles with stillness. In modern life, everything is instant: messages, entertainment, even food. Trading tempts us with the same immediacy. The market is always moving, always alive. The novice feels, if I'm not in a trade, I'm missing something. But this mindset is poison. The more trades you take, the less selective you become. And when selectivity disappears, quality vanishes. The truth is, most of the market's movement is noise. Only a fraction of it represents true opportunity. If you cannot sit on your hands, you will waste your capital on randomness. The solution is discipline in selectivity. Limit the number of trades you allow yourself each day or week. Focus only on setups that meet every criterion in your plan. Treat your trades like ammunition: finite, precious, not to be wasted. A sniper does not fire at every shadow, he waits for the perfect shot. So should you. Journaling is another powerful solution to overtrading. Record not only your trades but your state of mind before entering. Ask yourself, was this trade truly part of my system, or was I bored? Was it driven by fear of missing out, or by discipline? Over time, patterns emerge, and awareness grows. Once you see your impulses clearly, you can control them. Trading is not about constant action, it is about precise execution. One good trade is worth more than 10 random ones. By breaking the habits of overtrading and grounding yourself in patience, you shift from gambling to professionalism. These are the first two reasons why most traders remain unprofitable: lack of a clear plan and the destructive habit of overtrading. They may sound simple, but they cut deeper than most realize. Without a plan, you drift. With overtrading, you drown. Together, they form the trap that swallows most traders before they even begin. The third reason most traders remain unprofitable is the fear of missing out, commonly known as FOMO. It is one of the most destructive forces in the markets, because it hijacks your decision-making. You see a candle spike, you hear others bragging online about catching the move, and suddenly your brain screams, "I need to get in before it's too late." The problem is, by the time you feel this way, it is already too late. The move has already happened, and you are entering at the worst possible price. FOMO is rooted in our evolutionary psychology. Humans are social creatures. Thousands of years ago, being left out of the tribe could mean death. Today, missing out on a trade carries no real danger, but your brain treats it as if it does. The result is impulsive action that sabotages your process. The painful truth about FOMO trades is that they rarely work. You enter too late, often at the top, and the market reverses against you. Instead of profit, you're left with regret. That regret fuels more chasing, and suddenly you're in a spiral of bad decisions. It's a cycle that drains accounts and confidence alike. The solution to FOMO is twofold: awareness and structure. First, you must recognize when FOMO is speaking. When you feel urgency, when you think, "I can't miss this," pause. Urgency is not a trading signal, it's an emotional signal. Second, rely on structure. If the trade does not meet the criteria in your plan, you don't take it. End of story. Your plan is the gatekeeper that protects you from emotional impulses. One of the most powerful tools against FOMO is reframing. Instead of seeing a missed trade as a loss, see it as a victory. Why? Because you didn't break your rules. You didn't chase. You stayed disciplined. That is a win. Opportunities in the market are infinite. Missing one does not matter. Protecting your mindset does. Closely tied to FOMO is the fourth reason you remain unprofitable: lack of discipline. Even with a plan, even with knowledge, many traders fail simply because they cannot follow their own rules. Discipline is the bridge between theory and reality, and without it, nothing works. The psychology behind discipline is fascinating. Humans are wired to seek comfort and avoid pain. Following rules often feels uncomfortable. Cutting a loss feels painful. Sitting on your hands feels boring. But these actions are necessary for survival. The undisciplined trader avoids discomfort, and in doing so, avoids success. Discipline means cutting losses without hesitation. It means sticking to your risk limits even when you feel tempted to double your size. It means walking away after a bad trade instead of seeking revenge. None of these choices are easy, but they are the difference between amateurs and professionals. A lack of discipline often shows up in small breaches. Moving a stop loss, just a little. Taking one extra trade after your limit. Ignoring your rules, just this once. These cracks in discipline may seem small, but over time they destroy consistency. The market punishes weakness relentlessly. The solution is to make discipline non-negotiable. Treat your rules as law, not as suggestions. Build accountability into your trading. This could mean reviewing your trades with a mentor, or writing down your decisions in a journal to expose your own behavior. The more you hold yourself accountable, the stronger your discipline becomes. Discipline is not built in moments of comfort. It is forged in moments of pressure, when everything in you wants to break the rules. Every time you resist, your discipline grows. Every time you give in, it weakens. Over months and years, this becomes the defining factor in your results. FOMO and lack of discipline are two sides of the same coin. FOMO pushes you into bad trades, lack of discipline keeps you from following through on the good ones. Together, they trap traders in endless cycles of inconsistency. Breaking free requires self-awareness, strict rules, and the courage to act in alignment with them even when it feels uncomfortable. The fifth reason most traders remain unprofitable is poor risk management. This is perhaps the most common and most dangerous mistake, because even a winning strategy cannot survive without proper risk control. Risk management is the foundation of longevity in the markets. Without it, one bad trade can erase months or even years of progress. Most traders fail to respect risk. They risk too much on a single trade, believing that this one will be the big winner. They increase size after a losing streak, chasing what they've lost. They ignore stop losses, convinced the market will turn back in their favor. Each of these behaviors is a symptom of poor risk management, and each can end a trading career. The psychology behind poor risk management is rooted in greed and denial. Greed whispers, risk more, and you'll make more. Denial whispers, this trade won't fail, you'll be fine. These voices are seductive but deadly. The truth is simple, no strategy wins 100% of the time. Losses are inevitable. If you risk too much, a loss is not just painful, it's catastrophic. Professional traders think differently. They never risk more than a small percentage of their account on a single trade. They understand that trading is not about one big win, but about thousands of small, disciplined actions compounding over time. Risk management allows them to survive long enough for their edge to play out. The solution is clear: define your risk before you enter. Decide how much you are willing to lose if the trade fails, and stick to it without exception. Most professionals risk 1 to 2% of their capital per trade. This keeps losses manageable and ensures survival through drawdowns. But risk management is not just about stop losses. It's about total exposure. Many traders take multiple positions that are highly correlated without realizing it. They think they are diversified, but in reality, they are risking far more than they planned. True risk management requires awareness of correlations, position sizing, and the overall health of your portfolio. Think of risk like oxygen. You don't notice it when it's there, but when it runs out, nothing else matters. Without risk management, every other skill is meaningless. Poor risk management is the silent reason why so many traders blow up. Fixing it is non-negotiable if you want to survive. The sixth reason traders remain unprofitable is emotional trading. This is perhaps the most visible mistake, because you can see it in real time when traders abandon logic and follow feelings. Emotional trading comes in many forms: revenge trading after a loss, euphoria after a win, panic selling at the bottom, greed-fueled chasing at the top. All of these behaviors stem from one truth: emotions overpower discipline. Emotional trading is rooted in the way our brains evolved. Fear and greed are survival instincts. Fear keeps us alive by alerting us to danger. Greed drives us to seize opportunities. In the wild, these instincts were essential. In the market, they are destructive. The same emotions that helped us survive as hunters now sabotage us as traders. Consider the trader who loses on a setup. Instead of accepting the loss, he feels anger. That anger demands revenge. He re-enters impulsively, often with more size, desperate to win back what was lost. The second trade fails too, and the spiral deepens. This is revenge trading, the purest form of emotional trading. On the other side, consider the trader who wins big. Euphoria floods his brain. He feels unstoppable, invincible, smarter than the market. This overconfidence leads him to take reckless trades, risk too much, and inevitably give back his gains. The market feeds on these emotions. It punishes fear, it punishes greed, it punishes those who cannot detach. Emotional trading is the reason why so many accounts fluctuate wildly before eventually crashing. The solution lies in self-awareness and structure. First, you must recognize your emotional triggers. What happens to you after a big win? After a big loss? Awareness is the first step to control. Second, you must build systems that protect you when emotions rise. This might mean a rule that after 2 losses in a row, you stop trading for the day. Or a rule that you never increase risk after a win. Structure protects you from your own impulses. Another solution is ritual. Many successful traders use routines to calm themselves before trading: meditation, journaling, even something as simple as deep breathing. These rituals train your mind to enter a focused, detached state before you risk capital. Above all, emotional control requires perspective. One trade means nothing in the grand scheme. A single loss is just data. A single win is just a point in the curve. When you zoom out, the emotional highs and lows lose their power. The market is not about today, it's about the next 1,000 trades. Poor risk management and emotional trading form a deadly combination. One feeds the other. When you risk too much, your emotions explode. When your emotions explode, you abandon risk management. Breaking this cycle is essential for profitability. It is not easy, but it is possible, and it begins with humility, discipline, and structure. The 7th reason most traders remain unprofitable is a lack of consistency. Consistency is the heartbeat of profitability. Without it, there is no way to measure progress, no way to refine an edge, no way to build confidence. Yet most traders change strategies, indicators, or time frames every few weeks, always searching for the perfect system. This constant switching is poison to progress. Why does this happen? The answer lies in psychology. Human beings crave novelty. When something feels new, it excites us. It gives us the illusion of progress. But in trading, novelty is dangerous. Every strategy requires time, patience, and repetition to reveal its true edge. If you abandon it too quickly, you never give it the chance to work. Inconsistency also comes from impatience. Traders want results now. They think, if this isn't working after 2 weeks, I need to change. But the truth is, no edge can be proven in such a short time. Professionals think in hundreds of trades, not in a handful. Consistency is not about instant results, it's about giving your edge the time to express itself. The result of inconsistency is a vicious cycle. You test one system, lose a little, and switch. You try another, lose again, and switch once more. After months or years, you have dozens of half-learned methods and zero mastery. Instead of progress, you are stuck in perpetual restart mode. The solution is commitment. Choose a system, test it, refine it, and stick with it long enough to collect meaningful data. This doesn't mean you ignore obvious flaws, but it does mean you stop abandoning strategies at the first sign of trouble. Consistency allows you to learn deeply. It builds skill, trust, and identity. A professional trader doesn't need a perfect system. They need a consistent one. Because with consistency comes adaptation, and with adaptation comes mastery. If you cannot be consistent, you cannot be profitable. The 8th reason traders fail is ignoring psychology itself. Many focus entirely on technical analysis, candlesticks, indicators, chart patterns, while neglecting the mental game. They believe success comes from mastering the market, not realizing the true challenge is mastering themselves. This is perhaps the greatest irony of trading. The majority of traders lose money not because their strategy is flawed, but because their psychology is. They break rules, chase trades, over-leverage, and panic under pressure. They sabotage their own edge. And yet, instead of addressing these behaviors, they keep searching for new systems, hoping the next one will save them. Ignoring psychology is like a pilot ignoring his own stress levels while flying. The plane may be mechanically sound, but if the pilot panics, disaster follows. Trading is the same. Your mind is the cockpit. If you lose control of it, no system can protect you. The reason psychology is ignored is simple: it's uncomfortable. It requires self-honesty. It forces you to confront your weaknesses, your impulses, your fears. It is far easier to download another indicator or buy another course than to look in the mirror. But until you do, you will remain stuck. The solution is to prioritize psychology as highly as analysis. Study your own behavior as carefully as you study charts. Keep a trading journal not just of entries and exits, but of emotions, thoughts, and decisions. Reflect on patterns in your behavior. When do you break your rules? What triggers impulsive trades? Where does fear show up? Awareness is the first step to mastery. Another solution is to train your mind intentionally. Just as athletes train their bodies, traders must train their psychology. This can mean meditation to calm emotions, visualization to prepare for stress, or routines to anchor discipline. It is not optional, it is essential. The truth is, psychology is the edge. Two traders can trade the exact same system, yet one makes money and the other doesn't. The difference is psychological execution. If you ignore this, you will forever remain unprofitable, no matter how advanced your technical skills become. Lack of consistency and ignoring psychology are linked. Inconsistency often comes from ignoring the psychological discomfort of sticking to one plan. And ignoring psychology often leads to the very inconsistency that destroys progress. Breaking free requires courage, the courage to commit, the courage to self-reflect, the courage to face the real battle, the one within. The ninth reason why most traders remain unprofitable is that they keep no journal, no system of feedback, no way to learn from their mistakes. Imagine a pilot who never checks his instruments, who never reviews what went wrong after a failed landing. Imagine an athlete who never watches the replay of his matches. Improvement would be impossible. Yet countless traders treat their careers this way. They trade blind, day after day, with no record, no review, no feedback loop. The psychology behind avoiding journaling is resistance to discomfort. Writing down your trades forces you to face reality. It forces you to see your mistakes in black and white. And that is painful. Most traders prefer to forget losses quickly and move on, pretending they never happened. But what you ignore, you repeat. What you face, you can fix. A journal is not just a log of entries and exits. It is a mirror for your psychology. Record not only your trade, but why you took it, how you felt before, during, and after, and whether it followed your plan. Over time, patterns will emerge. You will see the habits that sabotage you, the boredom trades, the oversized risks, the rules you break under pressure. Only then can you address them. The solution is to treat journaling as part of trading, not as an optional extra. Each trade you take is incomplete until it is recorded and reviewed. Set aside time weekly to analyze your journal. Ask yourself, what did I do well? Where did I break discipline? What can I improve next week? This reflection is where growth happens. Without it, you are simply repeating the same behaviors, hoping for different results. The 10th and final reason most traders remain unprofitable is mindset, specifically, the wrong mindset about what trading is and what it requires. Too many enter this game believing it is a fast path to riches, a way to escape their problems overnight. They dream of turning a small account into millions in a year, of quitting their job after a few weeks, of living off trading profits instantly. This mindset is poison. Trading is not a lottery. It is not a shortcut. It is a profession. It requires years of practice, thousands of hours of study, and relentless self-discipline. Those who come in with a get-rich-quick mindset almost always burn out. They take reckless risks, chase every setup, and when losses come, they crumble, because their expectations were never realistic. The correct mindset is long-term mastery. Trading is a craft, like medicine, law, or athletics. It requires education, apprenticeship, trial and error, and humility. If you treat it like a serious career, it will reward you like one. If you treat it like a gamble, it will punish you like a casino. Changing your mindset requires honesty. Ask yourself, why am I trading? Am I here for excitement, or am I here for consistency? Do I want quick thrills, or do I want long-term freedom? Your answers reveal your path. If you seek excitement, you will always sabotage yourself. If you seek mastery, you will commit to discipline, patience, and growth. The wrong mindset blinds you to reality. The right mindset opens the door to consistency. And consistency, over time, is what builds profitability.